Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into the idea that we're in an environment of really significant uncertainty around DC policy, but we're sort of at a state where we're watching for that uncertainty to clear a little bit, to fade. And so with that, basically, let's kind of get into what's happening, starting, of course, with the DC activities and their effect on the market. So recall we've talked before about the idea that we modeled out a bear case scenario for 2025 in our outlook. And in some ways, some of the concepts that we got into in that discussion have played out. So the idea that there's been erratic policy shifts, sometimes poor communication about that policy, and ultimately, especially when it comes to trade and worries about trade, there's been an erosion of animal spirits, sort of those positive energies that keep businesses and markets going. So that has unfolded a bit here in 2025. There's worry of a U.S. recession. There's worry of a global recession. And if you were to couple that with still elevated inflation, that would be stagflation, which is viewed very negatively. And so there's been this overarching sense of worry against a backdrop of significant change in DC. So we know that there's tariffs and trade negotiations happening. We know that there's going to be a focus on tax rates and where to go from here. We know that there's an effort to sort of reset the government, both in terms of spending, the Department of Government Efficiency, or DOGE, but many departments really reorganizing. So there's focus in health and human services. Of course, there was changes in terms of how immigration was handled, and then Department of Education, Department of State. There's basically big changes going on. And so just tracking that and thinking about it is really kind of important in the market environment, again, around people not understanding it, or there being poor communication, or the potential for policy error will all translate to market volatility and potentially weaker markets. Now, at Stifel, we're super blessed to have a number of colleagues doing a bunch of different kinds of work, but one of those individuals is Brian Gardner, our Chief Washington Policy Strategist. As you might appreciate, I've spent a lot of time in recent weeks with Brian, sometimes at client meetings and such. And, basically what I would say is Brian's been really on top of what's going on in DC. As the tariff thing hit, for example, he kind of framed up an idea that you could have the tariffs stay in place, you could see negotiation, or you could see a pause. And at the moment, a lot of folks kind of question that last possibility, but of course, that's how it's played out. And so it's been great to have Brian essentially immersed in the topic and encourage people to check out his work at stifelinsights.com. In any event, as it relates to this as a backdrop, what we've seen so far is that the economy has held up okay. We got back to trend growth since the shutdown of the pandemic. But what we're seeing kind of across the board, including our colleague, Dr. Lindsay Piegza, our chief economist, basically folks are lowering their forecast for 2025. And the range is from, round numbers around 1% to, let's say, 1.7%. Dr. Piegza, so Lindsay, she reduced her forecast to 1.6% recently. And then when we look across the industry, there's just a handful of firms that are anticipating a second half technical recession, meaning negative growth in the third and fourth quarter. But the consensus isn't there. And so think of it as, continued positive growth is what we think. But not as strong as was originally expected. Now, Dr. Piegza, another thing I would comment about with her is the idea that she talks a lot about the environment, about inflation, and about Fed policy, and as you'd expect. And so she's anticipating higher inflation, and we have good debate. I'm not sure I agree that it's going to go quite as high as she's anticipating, but that's the fun thing about the debate. In any event, her view, therefore, is that the Fed shouldn't cut rates because of the inflation problem. And that obviously is a strong stance. Now, notably, inflation in the last couple of prints for the consumer price index and producer price index were actually quite muted, right? So people are now anticipating a resurgence of inflation and that would be a force to kind of keep the Fed from cutting. But right now, the markets are pricing in, and it tends to bounce between 3 and 4 quarter-point cuts for the balance of the year. And, the punchline here is that the market's expecting the Fed to focus more on the potential eroding environment for the economy than inflation. And so it does bring into focus the Fed's dual mandate that they're trying to balance the idea of maximizing employment and keeping prices stable. But it's sort of a tough environment for that, in the sense that if we do see a significant slowdown in the economy or the risk of a recession, that has a big impact on jobs, obviously. And yet there's worry that the mechanics of tariffs will drive prices higher. And so the Fed is, obviously really focused on that balance of its dual mandate, and something that the market's, pricing in some rate cuts as a result. And yet we have experts like Lindsay Piegza saying, well, they should hold rates at the current level for inflation. All of this, of course, as it relates to Fed policy, relates to interest rates. It relates to the level of cost of debt, basically, both for companies and individuals together, as well as our federal government. And so we know that the idea of our fiscal trajectory, how the government's been spending money, and the need to tighten our belts in a way, will remain in focus, and we've got many leaders reinforcing the importance of that. In any event, as it relates to interest rates, they have remained somewhat elevated, and in some ways, while sometimes when the market expects a rate cut, market rates themselves fall in advance of that. That hasn't quite happened as much in this environment, and people are focusing on what can be called the term premium, which is what is it that investors want to get paid to hold the bonds. That has popped up a little bit against this backdrop of incrementally more concern around government debt and our ability to manage the debt. Now, turning to stocks, we know this has been a negative year. We know that markets fell quite a lot on Liberation Day when tariffs were announced, and then when the pause was announced, they've recovered a little bit relative to that drop. And they've sort of been moving up and down a little bit around uncertainty and fading uncertainty around especially trade. So right now we're getting signals that the administration's out negotiating with a number of countries, and even discussions now about some shifts in China policy in a direction to kind of ease some of the trade tensions there, but still a long way to go. Now, as it relates to the environment, one thing that we talk a lot about is we try to help people understand the context of the current environment. And so, for example, as I record this, the day before, we basically took a look at the market. The S&P 500 happened to be at a level of around 5,400. And the reason I get into that level is to say, look, one of the things we take a look at from time to time is we look back in time to the point at which the current level was the market record. So in the case of the level of 5,400, that was reached on June 18th, 2024. So one of the things I often talk to individuals about is we're talking about market levels and the pain of the recent losses. Is I say, well, yeah, it does feel emotional, but how did you feel back in June of last year? And it's often the case when you kind of frame a review like that, like to take a look at what's going on, people will say, well, gee, I actually felt pretty good in June of last year in terms of the level of my portfolios and things like that. And so it's almost like re-anchoring on the environment and understanding what's going on. And what I would say is, as it relates to sort of that dichotomy, there's this concept of loss aversion, which is that people feel good about positive gains, but emotionally they feel a lot worse about a sort of symmetrical level of losses, right? And so it is kind of the punchline here is that we have to kind of remind ourselves that even though you don't want to see the markets go down, it's actually part of what happens, and we have to sort of take into consideration some information that will help us remember the benefit of being invested long-term in the stock market. In any event, as it relates to the market itself, we've talked about this before. Markets have fallen a little bit year to date. They're at this recording down say in round numbers about 8% year to date, they still represents a slight premium to the 10-year average PE, excuse me, the current PE. And so on a cap weighted basis, again, the market's not overly attractive in a valuation sense, but when we look at an equal weighted approach, it is attractive, meaning that on average an 11% discount. So what we would anticipate is, again, some good buying opportunities within the stock market, but you want to be a little bit more diversified. Now, as we've talked about before, the pattern of the performance year to date down almost 8% on the S&P 500. We know that that's been led by growth-oriented stocks like the Mag 7, which is down, round numbers 19%. As of this recording. And, at the end of the day, diversified investors have benefited. So, for example, let's say value is down much less, but I think a more notable one would be non-U.S. markets actually up round numbers about 8%, the developed markets year to date. And honestly and interestingly, we've seen a modest weakening of the dollar. The dollar sort of bounces around, but had strengthened sort of up to and through the election. And then with all this trade tension, it's moved back down. And so investments outside the U.S. that are outside the dollar tend to benefit when the dollar weakens like that, means the other currencies are strengthening. Now, back to the pattern of the markets and this idea that we're down 8%. One study we've reviewed is the idea that when we look at the size of decline, we want to kind of another behavioral thing. Let's look at how often these declines happen. So when you cut it at negative 5%, basically that happens about twice a year. And this is based on S&P 500 index history. When you look at being down 10%, which is called a correction, that happens about every year and a half on average. Down 15% about every 3 years, and down 20%, which people call bear market, that's about every 6 years. And so the takeaway from that, in my view, is just to remind ourselves that this environment isn't all that unusual. In fact, another chart that we look at shows calendar year returns on the S&P 500. We happen to go back to the year 2000. And as you'd expect, when you kind of sprinkle all of those out, not the vast majority, but a good number of the majority, well above 50% of those years are positive. And yet, when you look within the year, you can see these drawdowns that can be quite sizable and still have, a positive year. The most dramatic probably of late would be 2020, when there was a peak to trough fall in 2020, of course, around the pandemic of 34%, but ultimately the market was up 16% that year. So that's a super extreme example. But punchline here is we're down, round numbers about 8% year to date. When the peak to trough this year so far on the S&P is down 19%. And so, the punchline here is these things happen, the volatility happens, but it's not uncommon for the market to recover from these challenges and move higher. And then, one final concept I would mention in terms of this review of the equity market is just to remind ourselves that when the market does decline, ultimately they'll hit an inflection and it'll start to recover. And sometimes that recovery can be very, very quick. It could be, within, a handful of months to recover the losses that were experienced. And so, that one of the punchlines is, again, if you're a long-term investor and you're going to feel that loss aversion, you're going to feel that emotion, it's super important if you're long-term to remain invested. Now, it's good to rebalance. It's good to be diversified. It's good to consider, new types of investments. But the idea is you really want to remain fully invested in that. If you sell, it's really super hard to figure out when to jump back in, and it's not uncommon to kind of miss a good chunk of the recovery if you're trying to play that game. It's really, really hard to do. So anyway, those are a few thoughts on the current market environment. Just as we always do, sort of close with a couple concepts. One is we remain very focused on our long-term investment themes when it comes to the work we do around innovation, like technology, AI, around a focus on resources and how companies are supporting that, a focus on demographics and how changes are happening given population dynamics. that relates to the new consumer, the idea that consumption is changing, and how are we setting up for that in our economy, and therefore what investment opportunities exist. And then one important thing, one of our long-term themes we've called productive competition. We've had it in place a long time. That really includes the idea of U.S.-China trade or U.S.-China competition and tensions, and these days trade. And so that remains, super in focus. I think the whole idea here is we'll see different deals when it comes to these trade negotiations around the world. But the one that's in keen focus for everyone is how will things land between the U.S. and China, and do we end up at a place that's, if you will, just a little bit more free trade oriented than where we started. Anyway, the second thing I'll just mention in closing out is to remind you to check out stifelinsights.com, where we keep all this work from Dr. Piegza, work from Brian Gardner as well. And, it's all there for you. So we really appreciate you, following the work and listening today. Have a great day, and we'll be back in May.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.